Hi, what's up? Good morning. Today we are going to start with corporate finance, one of the most interesting topics in CFA level 1. Why do I say interesting? Well, because this is the topic which has the lowest effort to marks ratio. Well, the efforts required here are relatively low because the quantum is very less compared to the marks that has been allocated to it. So we just have 5 readings here, and it's very interesting and very practically relevant topic, of course, like the other topics. But here you will learn a lot of, I should say, logics about running the business and evaluating projects. So it's very, very useful for people who are in the project financing or in, working in multinational conglomerates where they are evaluating small, large projects on a daily basis. So this is an excellent topic for them, right? Thank you and enjoy the topic. Thank you. Okay, so today we are going to start with corporate finance. Before I introduce the topic, I would like to perhaps describe what is the weightage of this topic. So, like equity investments and other topics, corporate finance has around 8 to 12 percentage. On average, you can say around 10 percentage. But the most interesting part is that when it comes to effort to marks ratio, where you say efforts divided by the marks, this uh, topic has this subject has the lowest ratio. Why? Because I say here it is relatively easy compared to the marks that it has been given. When you compare topics like derivatives or portfolio management, they are a bit tricky, especially portfolio. If you see, it's large, it's vast enough compared to the marks that has been allocated, only 5 to 8%. uh, in comparison to that, when I see corporate finance, we just have 5 readings in corporate finance, and they're relatively very, very, very easy and interesting as well. So here the efforts to mark ratio is relatively less. The quantum of things that you have to read is less compared to the marks. So this is one of the most scoring subjects in level 1, and very interesting subject as well. So today we will start with corporate finance. Now, here there are 5 readings, 31, which is a completely theoretical reading where you have to understand about corporate governance and ESG. In reading number 32, you are going to be evaluating the projects. It's capital budgeting. But what we are going to start with is reading number 33, that is cost of capital. So first we'll understand what is the cost of capital and then the risk, that is leverage. So we'll be starting with these two topics, and then we'll go back to capital budgeting, where we will understand evaluating the project based on the cost of capital that we have identified in reading 33, right? So we'll first do 33, 34, then 32, and then finally we'll do reading number 35, which is about working capital management. Basically, once you start the project, how you should manage your cash inflows and outflows, how you should manage your resources and usage of funds. That's what we'll be seeing in reading number 35. And finally, I'll be doing reading number 31, which is the theoretical part. However, when it comes to reading, you can pick up any topic. You can start with the flow that the institute has given to, but I would always recommend start with 33 and 34, then start with 32, 35, and then go for the theoretical reading, that is 31. So I'll be doing it in that flow only because that's how it is interconnected. And for exam also, if you do it in that flow, you'll find it relatively easier, right? The second most important thing is that um, this topic, there are various topics which are overlapping, as well as the thing is that when I will be doing your equity cost of equity calculation, many of these things are in equity valuation. So I may do here in a short version. In detail version, we'll be doing that in equity valuation. In the same way here, when I'll be doing cost of debt, the detailed version of that will is what we'll be doing in fixed income. So here it will be just an introduction. Here the focus will be just to calculate weighted average cost of capital. Most of the things that you see in detail of the formulas that you'll come across, those in detail aspect of the formulas you'll see in the relevant topics, in the relevant subjects. So when we'll do equity valuation, when we'll do fixed income valuation, at that time we'll see more detail about the formulas that you'll be seeing in this topic. So Don't worry, in this topic, you're just going to get introduced with the formulas, the derivation of them, or in detail version of them that you will see in the relevant equity and debt, fixed income related topics. Okay. So your our focus is not going to be going in detail about the formula. Your our focus is going to be in just calculating the cost of capital. As I said again and again, the detailed version you'll see in equity and fixed income, where we have enough readings to understand the derivation of the formula. Correct? That's how we'll proceed. So we'll start with reading number 33, that is cost of capital. I think we'll wait for 5 minutes more and then we'll start with. Okay. Should we start or wait?
We can wait for 5 minutes. It's up to you.
If it was up to me, I would never wait. Thank God it is not my classroom. I'm famous or defamous, I should say rather, to not let students come in the class after 7. I make them wait outside or send them home. That's what I do when it comes to the actual classroom. Fortunately, now we don't have that scenario. So fortunately for you, otherwise I'm very strict with my timings that we have to be there. It's okay, but in CFA you don't have to be that time conscious. In CA, where we take lectures every day for 3 to 4 months, that if people don't come on time, then the portion gets delayed by a month and all. So that's very difficult in other courses like CA, where you have around 100 or 120 lectures at a constant rate. So there everything has to be calculated. It's that micromanagement, which is very essential there. However, in CFA, that's because everyone is working, then there's quite a flexibility there. It's okay. So you have to deal students in a different manner for different courses. And in that also, if you're teaching at different location, you have to deal in that way. And now, above all that, now different platforms. So on online, you have to be a little less stricter when compared to offline sessions. So of course, I very much miss that part of being in the class and interacting with students, seeing their notes, how they do it, how they write it. Are they writing the way that I want or the institute wants them or not? So I have that habit of going onto the desk and checking everyone's notes and ensuring that everyone is well versed with the calculation. So that is a part that I very much miss. Okay, let's start with cost of capital. Now, why do I start with cost of capital? Why not with capital budgeting? Well, let's focus on capital budgeting for a while. What is capital budgeting? Capital budgeting is a point where you're going to evaluate between projects. Which project should I go for? Should I go for project A or project B? Well, when you are about to select between multiple projects, your focus is going to be on the future cash flows that you're going to receive from the projects. Of course, the project which gives you maximum cash flow is the project that you will select, correct?
Yes.
However, in order to invest in the project, you'll have to put some money now, correct? So you put some money now, which is your cash outflow, and in the future, you'll get cash inflows. But what if two projects are going to have different cash flows, different cash inflows and outflows? Then how do I evaluate them? Well, we evaluate them by bringing everything to the present value. So we bring all the future cash flows to the present value whether it's cash inflow or outflow for both the projects, and then we see which projects gives us maximum net asset value, which is the present value of the project now. Now, based on this NPV, net present value, we will select project A or B or C, whichever is the highest NPV giving project. But here is the most important catch, that the cash flows I will estimate and predict, but the discounting of those cash flows in order to bring them at present value happens at an opportunity cost of capital. Opportunity cost of capital, this is also called as the cost of capital. This is the cost of the capital that you raised for this project. Where do you get the capital from? You get the capital from debt or equity, correct? And this capital is not free. So there is a cost involved with this capital. The cost of this capital will become your benchmark or your hurdle rate or your discounting rate, based on which you will bring the cash flows to the present value. And after that, you'll be able to identify which project is feasible, which project is doable, and which project is most profitable. So the most important thing in evaluating the project is going to be your discounting rate. That is your cost of capital. Now, do you want the cost of capital to be higher or lower? Definitely, you want the cost of capital to be as low as possible. So the present value of your project is going to be highest, correct? So here we are going to understand that what are the components in that cost of capital, in that overall cost of capital, which is what we are going to now see, weighted average cost of capital. You have debt, equity, and within equity also you have preferred equity and common equity. So as I said, these capitals are not free and they do have a cost. So what is going to be the cost of these components, which together will make the weighted average cost of capital? So we'll first understand what is going to be the cost of capital here. In the second reading after this, we are going to understand, in reading 34, we are going to understand leverages. That is the risk involved in it. And based on that, then we'll go in reading number 32 in evaluating the capital budgeting, evaluating the projects. Correct. So before I start the cost of capital, I want you all to be well versed with why are we doing this topic, right? We are doing this topic so that we know the cost that we are entering into when we go into the projects. Correct. That's what we'll be seeing. So let's focus on weighted average cost of capital. As I said, what is weighted average cost of capital? Before I describe everything, what is your understanding of weighted average cost of capital?
That it should be low.
It should be low. Okay. And it is the cost of your overall, the cost of the funds that you have raised for the project. Okay. I'll repeat, it is the cost of funds that you have raised for the project. Correct. So the weighted average of cost of capital is also referred to as MCC, marginal cost of capital. Marginal cost of capital is the cost of, what do you mean by marginal? Marginal, by the way. Marginal means that one level extra. So for every, additional, very good. So margin it is basically every additional capital that you raise, what is going to be the cost of it. So let's say my company already has $100 million of capital. Now I've decided to get into a project which requires $20 million already. Now this 100 million which I already have is already involved in various other projects. Now I have to take another project which requires $20 million. So how will I get this $20 million either from the debt or equity or a combination of both? So what is the cost of capital of this $20 million which I'm going to put in the new project? That is called marginal cost of capital. Correct? Now, as I said, in this weighted average cost of capital, there are various components. Components like, where do you get the capital from? Debt, preferred or common equity. Right? This is called the component cost of capital. These are the components in the overall cost of capital, which on a weighted average basis will become WACC, WACC. So WACC is the cost of financing the firm's assets and can also be viewed as an opportunity cost. So this is also called as opportunity cost. What does it reflect? Well, it reflects the risk involved in the project. The higher the cost of capital, the higher, because the risk is higher, so you require what? Because the risk is higher, so you require more returns, correct? Your shareholders will require more return. Your debt holders will require more return. So if the risk is higher, the cost of capital will be higher. And therefore, if the cost of capital will be higher, then you'll require more cash flows to make it comparable to another project, which is relatively less riskier. So the conclusion is that higher the risk, higher will be the cost of capital. Am I correct? So WACC reflects the average risk of the project. So let's say you are evaluating 10 different projects. What is going to be the average risk of the project? That is going to be WACC. But when I say average, it means that there are some projects which are very highly riskier. In that case, I may have to adjust the WACC a little upwards based on the risk. Simultaneously, I may have some projects which are relatively less riskier than the average. In that case, I may have to adjust the WACC downwards. So WACC is, that is weighted average cost of capital, is an average risk. Based on the risk of the project, you evaluate, you adjust it either upwards or downwards. Clear? Everyone?
Yes.
Now, there are three forms of capital. I'm repeating again and again. Which are the three forms of capital we are going to use? Debt,
equity, preference.
Yeah, in equity, basically, when I say equity, we have two types of equity: preferred and common. The unfortunate part is that we in India have been told that debt, equity, and preferred equity are three different things. Well, ideally, equity is only one thing. Within equity, we have common and preferred equity, but here we have a tendency of saying common equity as equity by default. So in reality, let's make it correct now. It is debt, common equity, and preferred equity. Well, common and preferred both are called as equity only. So it's a bifurcation. It's a segmentation within the equity. Correct. So when I say what are the sources of capital, ideally it is only debt and equity. Within equity, we have first preferred equity and then common equity. Correct. So we will understand the cost for all of them. Now, of course, I'll go in detail. Here you see the formula, that is cost of debt is interest 1 minus T, cost of preferred shares, and cost of equity capital. But remember, we will go in detail, of course, when we do cost of debt. It is only cost of debt, where what do you pay to the debt holders?
Interest.
And tell me one thing, is interest paid before tax or after tax?
After tax.
Before.
I think interest ideally is paid. If you see the income statement, sales minus cost of goods sold, then you have gross profit, then you have operating expenses, then operating profit minus interest. So if you see the flow of income statement, the interest portion comes after EBIT, but before the tax. Correct? Am I correct, everyone?
Yes.
So interest is the only amount which is paid before tax compared to the preferred dividend and the dividend for common equity. For preferred dividend, for preference shareholders, you pay the preferred dividends, and this dividend is paid. This dividend is paid
After tax.
After the tax. Even the dividend that you pay for common shareholders is after the tax rate. So therefore, it is only and only in the case of debt that we will always say after tax cost of debt, where we will have to take after tax adjustment. We'll have to do the adjustment in the interest. We will see that when we do cost of debt, not now, but I'm just giving you a hint that in case of debt, you will always see 1 minus T, but not in other cases. Why is that so? In case of debt, you will see that, but not in other cases. Why that? Why is that?
Because it is after tax.
Because interest is paid before tax. Interest is paid before tax, but we have to see the cost of capital after tax, and therefore we'll be adjusting 1 minus T when it comes to debt. Okay. So I've mentioned a small reason here. We do KD 1 minus T because in many countries, interest paid on corporate debt is tax deductible. So whatever interest you've paid, because of that, your taxable profit becomes low and you save on taxes. So let's say you pay interest of $100, but because of that, your tax is saved. Let's say there is a 30% tax rate. So your $30 of tax is saved because you show interest as an expense. So $100 is your interest, $30 is the tax that you save. So effectively you pay only 100 minus 30, that is 70. And this 70 is nothing but interest 1 minus t. Are you getting my point? So I don't pay the entire 100. I do pay the entire 100, but I get the tax savings of $30 on it. So effectively, I pay only $70. Got my point? Therefore, when it comes to interest, we will always do 1 minus t adjustment. Is that clear? Everyone?
Yes, sir.
Yes.
Okay. So based on that, we are going to see the weighted average cost of capital. Well, weighted average cost of capital, we will see what is the individual cost of capital of debt, preferred and common equity. But assume that you have the cost of capital, the component cost of capital, and then you have the weights. Weights basically means the proportion of debt, the proportion of preferred, the proportion of equity in the total capital. That is what we have weights. So here we are given the weights. If you see the weight of debt, preferred and equity, debt preferred, and I will write the weight of equity is being given to us. That is, weight of debt is 0.45, weight of preferred is 10%, and weight of equity is also 0.45. That is 45%. And then they have given us before tax cost of debt is 7.5. Well, do we require before tax or after tax?
After tax.
After tax. So I will now put your weight of debt into cost of debt 1 minus t. So my weight of debt is 0.45 into my weight of my cost of debt is 7.5, but 7.5 is before tax. So I will do multiply by 1 minus tax rate, and the tax rate is 40%. So this is going to be my weight of debt into cost of debt 1 minus t. Plus I will do weight of preferred shares, which is 0.1 times the cost of it, and they have given me the cost of preferred share is 9%. Plus I will do weight of equity, which is 0.45 times the cost of equity, and the cost of equity is 11.5. Correct? That will give me the weighted average cost of capital. Just calculate it, guys. Put everything into store one. So first you'll do 0.45 into 7.5 into 0.6. That should be store one. 0.1 into 9, store 2. 0.45 into 11.5, store 3. Then add all three, you'll get 8.1. Let me know if you get this answer.
Yes, 8.1.
8.1. So 8.1 is your cost of overall funds that you have raised. Now, based on this 8.1, you'll go and start evaluating the project. So let's say you have 3 projects where you're going to put this capital. So you will discount the cash flows of these projects or at 8.1%. Clear?
Yes.
Everyone? So weighted average cost of capital calculation is very simple. But now the entire topic is on the discussion. How do we get it in real life? Right? It's just not the mathematics that is involved here. It is the logic and the fundamental that is involved here. So in this entire calculation, we are definitely going to discuss about how to get the cost of debt, how to get the cost of equity, how to get the cost of preferred shares. And here in this example, it was ready-made given to us. But in real life, no one is going to give you the data and solve it. You have to find the data, whether it's the cost of the components or whether it's the weights. So how do I get the weights? Any idea? Where must have where would I find the weights? Any idea? Anyone? How would you understand the weights basically of the project where the company is going to put money? How would you know the weight of the capitals? How would you know whether the company is going to use debt and equity both, or only debt or only equity? And what is going to be the structure? That is more important. Before you understand the cost, how would you know about the proportion of debt and equity that the company is going to use for the project?
The management discussion.
Okay, the management discussion. One very good answer. Any idea, anyone? Have you ever thought about this? Because most of the education that we've done till now is about everything is ready-made given to you in the question and you just solve it. But in real life, how would I get the weights? Who's going to give me the weights? No one is going to serve me that on the platter, right? Well, what we need to understand is that every company has a policy which is called as the target debt ratio or target capital structure. Every company has a policy as to how much what mix of debt and equity they would be using when putting their money in a project, or they may have a capital structure for the overall company. So somewhere from this information, I need to extract what is the company going to use as a debt and equity mix when it comes to investment in a project. So first of all, if the company already has a target capital structure means company has decided that this is going to be our capital mix of debt and equity. Let's say a company has decided that we are going to put 50-50 debt and equity. This is our target. We are going to have 50% debt and equity. So that gives me a hint that whenever they will invest in a project, more or less they'll try to make a combination of 50-50 debt and equity, right? So in many cases, especially in established companies, they have a target capital structure. And based on that, I will get the weights. And of course, that will be provided by the company's management. So I will get the weight. Many companies have a policy of no leverage, no debt. So in that case, I know that clearly that the company is using only equity. They are not going to use debt. Some companies use enough debt, too much high of debt for their expansion, right? That's very much possible in an infrastructure company where debt is a substantial part of their capital compared to equity. So that's okay. That's not a problem. But I would want to know that what is the company's target capital structure? Many times the company's or the company's management indicates that or informs them that to the analyst that this is what our target capital structure is. And that is also quite visible when you look at their balance sheet. You can easily see the debt and equity mix that they have from the balance sheet, right? So very first, where would I get this information? From the company management when they have published what, or when they inform me about their what?
Target capital structure.
Target capital structure, correct. But not all companies are quite open about their capital structure policies. And it's not a rule for company to tell that, oh, for the future, we are going to have this capital mix. That's not a rule. Okay, companies have the liberty to use the capital mix that they want. So when the companies don't inform me, or that if that data is not easily available for me as to what is company's target capital structure, then what do I need to do? Well, then we need to see what is the current capital structure, that is what is the current debt and equity that the company has, not on the balance sheet only. Why? Because on the balance sheet, it is reported at the historical cost. Correct? On the balance sheet, you have the equity value based on how do you find the equity value? Share capital, reserves, and surplus. So it's based on the historical cost, or it's based on the book value, but not on the basis of market value. That is based on the current market price. So what we do, we take the current capital structure and use the market value for weights. We don't use the book value. We don't use the balance sheet value for weights. We use the current market value of that equity. And based on that, we find the weights. So let's say if your equity right now is $800 million and if your debt is $200 million, $800 million, how did I get that? Well, based on the current market price and the number of shares, correct? Number of shares outstanding. So if I have $800 million of equity and the $200 million of debt, then my equity and debt ratio will be 80 and 20%. Now that is the weight I will use. Now, where did I get this from? Current capital structure, basically from the current, financial structure of the company. This is when I will use when I'm not being provided with a target capital structure, correct? Everyone?
Yes, sir.
Then I will use a current capital structure and use market values, not the book values. Clear? If this is not available, then you see the company's trend. That means in the past, how has the company raised capital on a consistent basis whenever it wanted to evaluate a project, whenever it wanted to put money in the project. So we will examine trend in the company's capital structure, or probably when we get that information from the management's discussion, that in the past, what they had done for the project. Okay, that is what the second option is. And the third option, if this is not available, then the last option that you have is that you will have to see what are the other companies in the industry doing, or what is the industry average of capital mix, what is the overall industry doing, what is on an average, if the industry is using more debt, that if the industry is using 80% debt and 20% equity, I may use that. So in order to get weights, first thing that you will do is you will see the target capital structure. If target capital structure is not available, then current capital structure and market value weights, or trend in the company's capital structure of the past, or eventually you can take the industry average. That is how you can find the target capital structure, or that is how you can find the weights of the components. Clear, everyone? Right? Any questions here? Now, tell me one thing, that you already have a capital of $100 million, and let's say out of that 50% comes from debt and 50% comes from equity. So how much debt you already have? Out of 100, if 50 is coming from debt, so how much debt you already have in your books? 50 million, am I correct? Yes or no?
Yes.
So if I go to the bank again for asking for another debt, for additional debt, will the bank give me at the same rate, or a higher rate, or a lower rate? What do you think? I already have a $50 million of debt. Now I go to the bank and ask for more debt, or I go to the investors and I issue more bonds. What do you think? Will I get it at the same cost, lower cost, or at a higher cost? Think and tell me.
Higher cost?
And why is that so?
Because we just saw the marginal cost of capital where.
No, that's all okay. But what is the logic for a bank? Just think from the bank perspective, or think from a lender.
Because there is already a debt, and
Yes.
this is an additional debt.
So relatively, you're more riskier now, correct?
Yes.
And if you already have a debt, and above that I give you another debt, I am at a more risk compared to someone who is taking debt for the first time. Because in this case, you'll have to first pay to the previous lenders, and then I'll be paid, right? So the more and more you raise, and it's not the case only with debt, that also is the case with equity. The more and more capital you raise, basically, every marginal cost of capital that adds into the company, every capital that adds into the company, what is the conclusion here? The more and more capital you raise, the cost of that capital will keep on increasing or decreasing? Increasing. Therefore, the curve of marginal cost of capital is upward sloping. By the way, what is this curve? This is the curve of cost of capital compared with the amount of capital. So the more and more amount of capital you raise, the cost of capital is upward moving. Are you getting that, everyone?
Yes.
So if you see the amount of new capital raised, and this upward sloping graph is marginal cost of capital, it is upward moving. The more and more capital you raise, the cost keeps on increasing. Correct? Now, this is MCC curve. Everyone, marginal cost of capital curve. Everyone clear with this point first?
Yes.
Right. Now comes investment opportunity schedule. What is investment opportunity schedule? Well, it is nothing but it is a returns from the project, you can say. So it is also called as IRR of the project. Now we will see what is the IRR of the project when we do the capital budgeting topic. But IRR or returns of the project, for now you can just say. So here is a graph which will plot the returns of the project based on the capital that is being raised for the project. So what does IOS, investment opportunity schedule, does? It projects, it plots all the projects that the company or the firm can have, basically, with the respective capital requirements. For example, let's say for $100 million, I have a project which gives me 10% return. For $200 million, I have a project which gives me 8% return. For $500 million, I have a project which gives me 20% return, whatever. So based on the returns that you can achieve from various projects, I mean the projects with different size of capital, I plot them. So what do I get? I get the returns based on the amount that I'm going to invest. Okay. So here is the catch. As the firm makes additional investments, returns are not expected to increase, but rather they are expected to fall. What does it mean? It means that the more larger and larger projects you select, the projects with more and more amount of capital that you select, then the percentage return, I'm not talking the dollar returns, I'm talking the percentage returns keeps on increasing or falling.
Fallen.
Now this is very interesting. So what happens if you raise more and more capital? The returns from the projects keeps on decreasing, and the cost of the project keeps on increasing. So what is the biggest important takeaway from this point? That if you can get capital unlimited, does not mean you should get unlimited capital. If you have easy resource to capital, does not mean you should keep on raising capital. Why? Because capital is not free. It has a cost. And also you need to understand that if you have billions of dollars of capital, does not mean you should put billions of dollars into project. Are you getting my point? Because after a point, what happens that you won't get enough returns. The more and more capital you invest, the returns keeps on dropping. Are you getting my point? So if you see here, if I put investment opportunity schedule on the same graph of marginal cost of capital, what happens to the investment opportunity schedule, or the returns? You can say, simply you can say returns. The more and more capital is raised, what happens to the returns? The returns are having a downward slope or an upward slope? Downward slope. And the cost of capital has an upward slope. Everyone. So before I discuss anything else, I've taken, see, these are the different scenarios that you can see. The returns on the project, which is investment opportunity schedule. If you notice here, the returns are falling. Why are they falling? Because I'm raising more and more capital. Assume that way. So the more and more capital, the returns are dropping and the cost is increasing. What happens at point C? What is higher? The returns are higher or the cost is higher? Returns are higher. And the point below that, below point C, that is B and A,
They are lower.
no, B and A. Returns are higher. The cost is relatively lower. But after point C, you notice that the returns are low and the cost is higher.
Yes.
Okay. So now what if I had said point A is raising $100 million, point B is $200 million, point C is $3, $4, and $5 million. Well, it will tell you what is the capital that I should have maximum or optimum. Why do I say optimum? Because maximum capital can be unlimited, but you need to raise only that much amount of capital till the point where your returns are below or higher than the cost. The returns are higher than the cost. Correct? There is a point where the returns and the cost is same. Now, beyond that, you should not raise the capital. Beyond that, you should not raise the capital. So the point of intersection of the marginal cost of capital and investment opportunity schedule, that is return, is called optimum capital budget. What is optimum capital budget? It is the amount of capital raised and invested at which the cost is equals to return, at which the marginal cost of capital is equal to investment opportunity schedule or the returns. Everyone. So what happens if you when it comes to investment, which projects will you invest? Well, the firm should undertake all the projects where the returns IRR is greater than the cost of funds. costs. Are you with me, everyone?
Yes.
So can I say in this case, I will take A, B, and C, everyone?
Yes.
But no projects with IRR less than marginal cost of capital or marginal cost of additional funds should be undertaken. So I will not take D and E, even if they are profitable, but they are not as profitable as per my cost. So the conclusion here is that what is marginal cost of capital schedule, or they normally ask you what is the optimum capital budget. It is a point where the marginal cost of capital, which is upward moving, and the IOS, which is returns, which is downward sloping, at one point that they will intersect. That is your optimum capital budget. You should not raise more and more capital beyond this point, even if you have the capacity. Why? Because then your cost is higher than the returns. Clear?
Yes.
So this gives a very good light that only because the capital is cheap, that does not mean you keep on adding the capital. Right? You can't expand beyond a point. The cost will be keep on increasing and the returns will start dropping. So there is a point where the cost and returns are same. You should not increase your capital beyond this point. That point is called optimum capital budget. Is that clear?
Yes, sir.
So this entire discussion helps us understand what is the optimum capital budget and what is the debt equity mix in that. What should be the relevant weights in that? Is that clear, everyone? Any questions, anyone? And here is a small discussion that we had already done in the previous slide, that for average risky projects, the firm's cost of capital is nothing but weighted average cost of capital, right? But if the project is less risky, then you should adjust it. You should adjust the WACC downwards. If the project is relatively more riskier, you should adjust the WACC a little upwards. Is that clear? Any questions, anyone?
Sir, ये समझा नहीं last time.
So, okay. So let's say, what is WACC? Weighted average cost of capital is the average cost based on the risk of the project.
Yes.
Now, if I have 5 projects, and if normally what do? We evaluate all of them by a same cost of capital. Okay. But when I say weighted average, it's the average risk of the project. Based on the average risk, this is the average cost. But let's say if you have 5 projects and one of the project is relatively more riskier, then you should slightly increase the cost for that particular project. If the project is less riskier, then you should reduce the cost. So average risk is, let's say, 10%. If you are getting into a risky project, your weighted average cost of capital can be 12 there. If you're investing in less risky projects, it can be 8. The weighted average should be around 10. So companies, when I say weighted average cost of capital, it is just for average risky project. When you have more riskier, take more cost. When you have less risky, take less cost. So you, as an analyst, we will adjust the WACC based on the riskiness of the project.
How can we adjust the cost?
I don't get your voice at all.
How can we adjust the cost? Isn't it something that's fixed?
Subjective it is. It is very much subjective. And here also, when you are estimating WACC, remember one thing, okay, the entire project financing is estimation. You are estimating what will be the future cash flows. Point number 1. Second, you are estimating the cost that you are going to pay for the capital that you have raised. In that, well, in case of debt, you can say, well, the cost is visible because the interest is fixed. But that's not the case in equity. When we will today see what is the cost of equity is also an estimation that what shareholders want, what shareholders will get, because dividend is uncertain, capital appreciation is uncertain. So the entire corporate finance, the entire capital budgeting concept is estimation. Now, in this case, the cost itself, coming to the conclusion that you just have to see that, if the cost of capital is 10%, but if I'm investing in a much riskier project, how much is the risk involved? And based on that risk, I will slightly have to adjust the expected return. That is the cost. Now, how to do that? There are various methods. It's not that randomly I'll add 2 or 3%. That we will see now when we will understand a concept called beta. Beta is the measure of that risk. So if let's say if the beta is high, the cost will be higher. So we will discuss that today as well. Okay, but understand one thing, that you will have to adjust it. How to do that? That's what we will be saying. Clear?
Yes, sir.
So now let's go to the component, and the first component is cost of debt. Well, there are various methods within the cost of debt or equity to to find the cost. We will see all of them. The cost of debt financing is basically nothing but the cost that you will have to pay as a borrower. Okay, and as I said, we are going to take after tax cost of that. That is 1 minus T. Now, how do I get cost of debt? Well, there is one approach which is called the YTM approach. YTM is nothing but yield to maturity. It is the returns that the bond holders expect for investing in the bond till maturity. That is called
Yield to maturity.
yield to maturity. Yield means returns. Who wants the returns? The bond holders. So the returns that they want is the return is going to be the cost for the company. Correct? So for YTM, I need all the information of a bond. I need the present value. I need the future value. In bond, generally at maturity, it is paid as par. Correct? And then in between, you pay them the coupon, which will be your PMT. You remember that? We've done in cons, correct?
Yes, sir.
And then when you do compute I by Y, that I by Y is nothing but your cost of debt here. Clear, everyone? But remember, cost of debt has to be post-tax, 1 minus T. So first we'll find what is going to be the cost of debt. That is the YTM approach. YTM approach is exactly what we did in cons, time value of money, that is calculating I by Y. So let's read that and put up and try to find the cost of capital. So following information is related to a company. The after-tax cost of capital is what we have to find. You have got the face value, which is the par value that you will get on maturity as an investor. Maturity is 5 years. Issue price of the bond is 945. Coupon rate is 7% annual and tax rate is 40%. So let's find the solution. What should I put in my calculator, guys? First thing will be PV. How much will be the PV? I will put 945 negative. Am I correct? Negative.
Yes, negative.
Right. Then the FV will be par, that is 1000. Coupon, that is PMT. So your PMT will be, how much is it? 70, I should say, because 7% on 1000. N is going to be 5 years. So basically your CPT I over Y will be
8.4.
8.4. Do we have 8.4 as a choice? Yes. So should that be my answer?
Yes.
No. 8.4 is before tax. Remember, you have to adjust for tax, and they are smart enough. They'll give you a choice which you will take it by mistake. So what is cost of debt? You have to take cost of debt as 1 minus T. Am I correct?
Yes.
Don't do the mistake of forgetting the tax rate. So my cost of debt here is 8.4 into 1 minus tax rate. The tax rate here is given as 40%. So my after tax cost of debt will be 5.04. Am I correct?
Yes.
So don't be in a hurry here. B is our answer. Everyone. This is called the YTM approach. Why YTM? Here simply you have all the information of the bond, and based on that you simply get the I by Y. Exactly the same way we have done in time value of money. Clear, everyone? But don't forget to do. Don't forget to do
After tax.
after tax. Guys, here the price of the bond was 945. You can say this is the issue price or the current market price of the bond. But when will I get the current market price of the bond? If the bond is listed, isn't it?
Yes.
If the bond is listed, only then I get the market price of the bond. What if the bond is not listed? If the bond is not listed, in that case, we will have to use another approach, which is called as debt rating approach. Debt rating approach is an approach where you will see what is the credit rating of your bond. And based on that, what if there is already a bond with the same credit rating? So you take a comparable company whose bond is also of the same credit rating. And from that, you try to understand, oh, what is its cost of debt? Because that bond is listed and your bond may not be listed. So debt rating approach is an example where you are going to price your bond based on the characteristics of your bond, which are similar to an already listed bond. So it is generally used when reliable market prices for debt is not available, when you don't have the value for your bonds. And if they are, there is lack of liquidity and the price is not reliable. So here you are going to use a yield on comparable rated bonds, which I say proxy bonds, comparable rated bond. And you will assume that since you both have the same credit risk, that company's yield should be your company's yield. Okay, this is the easy method, but you will use this only when you don't have a choice, right? When you don't have the price available. If you have the price available, we will always use which approach?
Right. Y2M.
The YTM approach. If the price is not available, then only you go for debt rating approach. Clear? So here you are going to base your price based on an already listed bond with the same credit rating. But you may have to do some adjustment, and that's what we will see here. So they've written, suppose a firm's capital structure has a debt with average maturity of 8 years. And the firm's tax rate is 30%. If the firm's rating is AAA, which is the highest credit rating, and the yield on the debt with similar rating of maturity is 6.43%. So there are bonds with the same maturity, which has risk of 6.43%. The firm's after tax of debt is closest to what should be my after tax cost of debt here? How do I calculate that, guys? Anyone? No one? No problem.
No.
I expected this time you all to say, sir, take after tax cost of debt. 6.43 multiply by 1 minus tax rate.
4.5.
Correct, 4.50. Here it looks very simple because I've just borrowed the data from another company and used it. Okay. This is the laziest method, but you don't have a choice. It's a relative valuation. You use it only when your bond's data is not available. So if you see already there is another bond which is also listed with the same credit rating, you take that bond's yield and put it to your bond. Is that clear, everyone?
Yes.
As I said, this method you will only use when you do not have the price available or if the price is not reliable. Otherwise, we would not prefer this method. Otherwise, we would prefer the UITM approach. Now, why is it also called as matrix pricing? Here, the debt rating approach is a simple example of pricing on the basis of valuation, relevant characteristics, which in bond market has been known as evaluated pricing or matrix pricing. What does it mean? That, what if the maturity does not match exactly? In that case, let's say you have a bond here. What is the maturity of our bond?
8 years.
8 years. What if I give you an example? What if instead of an 8-year bond in the market, we have a 6-year bond whose yield is, let's say, 5%, and a 10-year bond whose yield is, let's say, 7%. So I don't have the 8-year, but I have 6-year and 10-year. So I'll have to do interpolation, right? And from that, I'll have to find the 8-year yield. And then I will take that 8-year yield for my bond. Are you getting my point? Correct. So you may have to use interpolation if you do not exactly have another bond available in the market with your same maturity. correct? So this is how you would find the valuation, and that's how we call it as matrix pricing. That's why we call it as matrix pricing. Is that clear? But again, one thing is common here. What is one thing? That I'm using other companies' data to find the cost for my bond. Is that clear?
Yes.
Right. Easy. Debt, cost of debt.
Yes.
Let's go to cost of preference shares. After that, who is that you pay? You pay to the preference shareholders, correct?
Yes.
Now, when it comes to paying the preference shareholders, what is the amount that you pay to the preference shareholders? Well, the only amount that you pay them is dividend. Only amount that you pay them is dividend. And this amount you pay forever, assuming that the preference shares, like common equity, they are for perpetual. So in that case, the only amount you're going to pay them is
Dividend.
preference dividend, that is forever. If you remember from the time value, we did calculate something called present value of perpetuity. What was the present value of perpetuity? You remember PMT over R? So
Yes.
PMT is the regular amount. In preference shares, what is the PMT here? The PMT I will get is preference dividend. And R is nothing but the cost of preference shares. Based on that, I get the present value of preference shares. But if I want to find the cost, what can I do? I can take the PMT divided by the present value. So PMT in preference shares will be
Preference dividend.
Preference coupon.
dividend, and present value of the preference shares will be in the denominator. That will give me the cost of preference shares. So it's exactly what we did in time value of money, that is perpetual calculation, present value of perpetuity. So here, when I will take the same formula, it's the same formula where we did present value equals to, instead of dividend, we took PMT, and here we took the cost, correct? So from the same, if I want to find what is going to be the cost of preference shares, R is basically nothing but the cost. I will use PMT, which is the preference dividend, divided by the price of the preference shares. Clear? That's it. So here my cost is going to be PMT over present value. That is the price. Very easy. So here I will see what information do I have. ABC issued preference shares which pays a dividend of 7. So I've already got the dividend as 7. And the current market price of the preferred share is 96. So if I do 7 divided by 96, I get the cost, which is 7.29, or basically I can say 7.3, because the choice is around that. First of all, do I have to deduct the tax rate? They've given me the tax rate. Should I do minus T?
No.
Why should I not do 1 minus T? Please explain.
Because it is after the dividend is given after tax.
Correct. So the amount that you have paid, the preference dividend, is already after the tax amount. So you don't have to do the tax deduction again. Correct. The preference dividend is already paid from the post-tax amount. Am I clear? So you don't have to pay the tax anymore. It is already from the post-tax amount. Therefore, even if the tax information is given, we are not going to adjust that. Is that clear?
Yes, sir.
Correct. Everyone? So here, my answer is going to be 7.3B, and don't get into the trouble by deducting the tax rate here. It is not debt, it is preference shares. Clear, everyone? Right. This is for the preference shares, where we are assuming that the preference shares are perpetual. If not, then you have another formula. You can use it, the debt formula, basically. The way we calculate it for debt, exactly same you can calculate for preference shares. So here you saw for debt, you have the par value, maturity, issue price of preference shares, and instead of coupon, you can say dividends, right? Tax rate is not required. So if the preference shares are not perpetual, then the calculation technique is exactly similar to what we did in YTM. If they are perpetual, then this is the way you are going to find the cost of preference shares. Everyone clear with this point? Any questions, anyone?
Yes. No.
No. See, one thing is for sure, when it comes to debt and preference shares, it is very real. Why real? Because it is already fixed that how much amount you're going to pay to the debt holders and how much amount that you're going to pay to the preference shareholders, because you have committed that. So when I calculate cost of debt and cost of preference shares, it is realistic because this is the exact amount, the certain amount that you're going to pay to the debt and preference shareholder. But the problem is with cost of equity. In equity shares, nothing is certain. The amount of dividend that will be paid to the equity shareholders, is it fixed?
No.
No, it is not fixed. Second, rather I should say first, whether the dividend will be paid or not, even that is not fixed. Am I correct?
Yes.
The third thing is that there is no maturity of equity shares. Preferred shares and debt can be issued for limited time period also. But can you issue equity for 5 years or 3 years? No, equity is by itself perpetual. So everything is uncertain about equity. Neither the amount that will be paid by the company in form of dividend, neither the amount, neither the dividend itself. Forget the amount of dividend. The dividend, whether it will be paid or not, even that is not sure. And the preference, like preferred or debt, the equity shares, the common equity shares do not have a maturity. So you don't know when you will exit, and at that time, what will be the share price. So in equity, everything is uncertain. And therefore, in order to find the cost of equity, various economists and mathematicians have given their their approaches to find the cost of equity. There are 3 famous approaches that we use not only in this topic, but we'll also find them in detail in equity valuation. The first is capital asset pricing model. Then you have dividend discount model. These are the 2 most famous approaches used by everyone who's in the industry, even now. Whether you are into equity research or investment banking or whichever field you are, people use CAPM, which is how they call, which is CAPM, capital asset pricing model, for finding the cost of equity, or they use dividend discount model. Now, of course, dividend discount model is replaced by free cash flow based models and so on. Free cash flow, remember something like free cash flow, which we had done?
Yes, sir.
In which topic? In FRA, some 20-30 years back. Remember that, everyone? Correct. Well, with the memory that you all have, I'm sure I have to say 20-30 years back. Correct. So in FRA, we have done free cash flow to the firm and free cash flow to the equity under the understanding cash flow statement. Correct, in that reading. So we will discuss the first 2 approaches, which are very famous, and then the third approach, which is the bond yield risk premium approach, is, I say, one of the laziest approach, because that is just not very relevant practically. But however, we'll understand all 3 approaches from the exam point of view. So here, why are we doing different approaches in KE, cost of equity? Because I said everything is uncertain. Okay. So the most famous approach, CAPM, cost of equity, is derived by Professor William Sharpe, the one who got Nobel Prize in economics for deriving this. We will understand the derivation of this formula when we do equity. I'm not spending enough time here in the derivation of it, because we are going to do the same in equity valuation. So when we will do equity valuation, at that time, we'll discuss the derivation of it. Okay. So just for your simple understanding, cost of equity here is risk-free rate. It is also known as expected return. It is risk-free rate plus risk premium, market risk premium. What is market risk premium? It is RM, market return, minus risk-free. So anything which is above risk-free is called risk premium. Repeat after me. Anything which is above risk-free is called as
Risk premium.
Risk premium.
Risk premium. So here it is called market risk premium. It means how much is the market giving you extra above the risk-free. Definitely, when you invest in markets, you want returns more than the risk-free, right? Because you're taking the risk. Clear? So what is the formula of cost of equity here? The formula is risk-free plus market risk premium, that is RM minus RF, multiplied with the beta of equity. Now, what is beta? The most important thing given by William Sharpe was the beta. What is beta? Remember, whenever I say beta, it means sensitivity. Beta means sensitivity. You know what? In the course that you have been with me, there are various topics that we have given one name. For example, risk means standard deviation or variance. Very good. Probability means chance, whether the event will happen or not. Correct? Yes or no, everyone?
Yes.
And sensitivity. Beta means sensitivity. What do I mean by sensitivity? Sensitivity, which means change in something due to something. Remember, sensitivity means change in something due to something. When it comes to beta, I'll repeat again and again, we are going to do this discussion at length in equity valuation. But just for your quick understanding, here I am assuming when I say beta, I say how much the stock will move due to market. That is sensitivity. So here the sensitivity of stock because of market. That is beta. Everyone with me? So if I say beta is 1, what does it mean? If the market moves by 10%, the stock will also move by 10%. Same 10%. But if I say beta is 1.5, that means the movement in the stock due to the market will be 1.5 times. So if the market increases by 10%, my stock's return should increase by 1.5 times. Are you getting it? That is 15%. And same goes for decrease also. So that's called sensitivity. How much sensitive is my stock when it comes to the market? Clear, everyone? So tell me one thing. Higher the beta, higher is the risk or lower is the risk?
Higher the risk.
Higher the risk, because more sensitive the stock becomes, correct? Clear? So based on this information, let's find what should be the cost of equity based on CAPM. So here they have given us that risk-free return is 5%, market return, which is of course going to be higher than risk-free return, is 11%. So here, if I were to find the cost of equity, my RF is 5% plus RM minus RF. That is how much? 11 minus 5. So 11 minus 5, 6% times the beta. What is the beta? 1.1. Now, before you all do the calculation, everyone hold on. Before you all do the calculation, tell me, is the stock riskier than the market or less riskier than market?
Riskier than market.
Riskier.
Riskier. Therefore, its expected return should be higher than market. Market return is 11%. So therefore, here the expected return from the stock should be slightly higher than 11%. That is 11.6 I get. Am I correct? Why is it higher? Because my stocks has relatively high beta. If the beta is more than 1, your stock's expected return, you want more returns from the stock than the market. Clear, everyone? Everyone?
Yes.
Easy. So 3 components here. What? Risk-free return, market risk premium, and beta. Based on that, you find the cost of equity. Is that clear, everyone? This is one of the most famous approaches. And as I said, we'll do more discussion about this in the later part as well. The second approach is dividend discount model. Under dividend discount model, you find the cost of equity based on the concept given by Gordon. Under the Gordon's growth concept, an investor who invests in the stock, he expects returns in 2 forms. Which are the 2 forms? Can you tell me? When you invest in stock, what is the returns that you expect from the stock? What is
Dividend?
your dividend and
Capital appreciation.
Capital appreciation. So capital appreciation will happen if the company grows. So that component is G, growth rate. And And the second component is dividend. How much dividend you will receive. So cost of equity is based on two components. The investor's return is based on two things: the dividend that they will get and the capital appreciation. The dividend basically, you are going to get some dividend for the amount of investment that you do today, right? So when you invest in a stock, are you investing for the dividend which was distributed last year, or the dividend which will be distributed in the future?
Future.
In the future.
In the future. So basically you are trying to find out what will be the dividend I will receive the next year, that is D1, based on the amount that I invest today, that is P0. Correct? This is called expected dividend yield. What is expected dividend yield? D1 over P0, which means today I will put, let's say, $100, and how much is the dividend I will get next year? This is called expected dividend yield. Yield means returns. Is that clear? D1 upon P0, everyone?
Yes.
This is the amount that I expect from dividends. Plus, the another amount I expect is from the appreciation in the price. But that appreciation in the price, which is the growth rate, will happen only if the company retains or distributes. What do I mean by that? Let's say the company, yes, let's say the company has earnings of $10. What will the company do with this earnings? Well, it will give some money as dividend, and the remaining amount it will retain. Am I correct?
Yes.
But if the company decides to pay $4 as dividend, how much will it be able to retain? $6. Correct. So here I can say the retention proportion is 60%. Why do I say 60? It is the retention amount over the earnings. That is 60% is the retention. Clear? So the company will grow on $10, $4 or $6 in this case.
$6.
Only $6, because 4 is going out. 4 is being paid out to the shareholders. That's not going to come back. Correct? So the company's growth depends on what is the amount which is being retained, that is retention ratio, and how much do you generate on that amount. Well, how much do I generate? That is called ROE, return on equity. Because whether the earnings is distributed or not, that belongs to the equity shareholders. So that is ROE. So the growth rate is a combination of two things. What are the two things in the combination of growth rate? How much is retained and what is the amount that you make on it. Clear, everyone? Everyone? So here, if I see in this example, what is the growth rate? How do I find the growth rate, guys? Growth rate is the amount that is retained, that is retention ratio, and multiplied that with the ROE, return on equity, everyone. So in this example that we see here, they have said the ROE is 12% and it expects to pay out 40% of its earnings. Guys, 40% is paid out as earnings. So how much is retained? Can you tell me?
60%.
60% is retained. And on that, they have said the ROE is 12%. So basically my growth of the company will be 7.2%. Everyone getting how did I get this?
Yes, sir.
So growth rate is a combination of retention, how much you are retaining and how much do you make on it. So we make 12% on every dollar retained. So I've retained 60%. So on 60%, I make 12. That is 7.2%. And now with this information, if I find my cost of equity, what is my dividend? They have said, suppose the company stock sells for 21, that is P0. Next year's expected dividend is $1. So I will do 1 divided by 21, correct? Plus 7.2. That is 7.2%. So my answer will be 0.1196, or I can say 11.96. Just verify if this is correct, guys. Everyone just see the calculation if that is correct. Everyone. Is the calculation correct? Let me know. One divided by 21 is D1 over P0 plus the growth rate of 7.2. Remember 7.2 is in percentage, so you can write 0.072 and you will get 0.1196.
0.96.
Are you getting it? 11.96, everyone?
Yes, sir.
No.
Can you tell me what you are putting in the calculator? Hello?
1 divided by 21.
Correct. Store it.
Yes,
Store
sir, I'm getting.
plus 0.072. Whatever the
Yes.
answer you get plus 0.072. I said
Yeah.
that this is in percentage.
Yes.
So either you do the first part into 100 and then add 7.2, or keep it as it is, the first part, and then add 0.072. So some people do what? They do this 1 divided by 21 into 100 and then they add 7.2 only. Either you can do that, or you can first calculate this, then you'll get some answer in 0.04 something. And then you add 0.072. Clear?
Yes.
Okay. Everyone getting this answer? 11.96.
Yes.
Okay. Now, these are the two most famous approaches used in cost of equity. However, many times for this approach and this approach of beta also, basically you require the stock to be listed. What if the company is not listed? Then you will not have the data of the price. Am I correct? You will not have the data of beta and all. You will have this data only and only if the stock is
Listed.
listed. But if the stock is not listed, what companies, what analysts generally do, they use another approach, which I call is a very lazy approach. Practically very less people use this. That is called bond yield plus risk premium. So when you invest in a company's bond, is that riskier, or when you invest in a company's equity, that is riskier? What is riskier?
Equity.
Equity or bond? Investing in a company's bond is riskier or equity?
Equity.
Equity.
Equity. Why? Because the first person to be paid will be the bondholders. So what these guys do, that they just take the bond yield of the company and add a very random or subjective premium. For example, if you see here, they have said that company's interest rate on long-term debt is 7.5. So that's the yield on company's bond. That is 7.5. If you invested in the company's bond, and they have said that the risk premium is estimated to be 4. So if you invest in equity, add 4 extra. So then 11.5 will be the yield on the company's equity. That will be the return on the company's equity. That is called the cost of equity. This is a very, very naive approach, but analysts use an ad hoc approach. This is an ad hoc approach. Why? This is generally used, especially when the company's equity is not listed and you don't have the data. Are you getting my point? In such a case, you can use this approach. Practically, companies don't use this approach. They take a weighted average of various things. Why? Because if you see here, 11.5, 11.96 and 11.6 are the three cost of capital same? Three cost of equity is all same?
No.
They are not same, because they all use different approaches, so they will not be same. So many analysts only use CAPM, many analysts only use DDM, some analysts use bond yield plus risk premium, but most of the analysts, they many times take a weighted average. They take an average of all the approaches. Are you getting my point, everyone? Clear? So you can use an average of various approaches. Why are there so many approaches in equity? Because as I said, in equity, everything is uncertain. Clear? How much dividend you will get, whether you'll get or not, what will be the share price, everything is uncertain. So in equities, you have several approaches. Everyone, yes?
Sir, how can we use weights in these approaches?
Weights? Which weights? In cost of equity?
Yes.
Where is weights? There is no weight in cost of equity.
मतलब weighted average.
Weighted average. Oh, weighted average we have already discussed, right? Where to use the weights from the target capital structure. You get the weights. This is where we understood how to get the weights. First, we understood it from the scratch. Where to get the weights? You get it from the company's
Capital structure.
capital structure. When generally companies disclose that what will be our capital structure, if they don't do that, then we discuss that you can use it from the current capital structure using
Yes.
market value weights. If not, then you see what is the company's trend in the past. And if that is also not possible, then you probably take an industry average for weights. So from here you get the weights, and then individually we find the cost. So then when you get cost of debt, preferred and equity, and then you get weights from the companies, as I said, from the company's target capital structure, and then exactly you find the weighted average cost of capital. I, as an analyst, how would I find, or how we used to find the cost of capital? We used to see the last 5 years company's debt equity ratio. Last 5 years company's debt equity ratio, and then we used to assume that, okay, the company in the future will also try to maintain that debt equity ratio. At times, you also have to read the management discussion and analysis where what is the company's approach? Is the company trying to reduce its debt or increase the debt? So from that also we used to gauge whether the debt equity ratio will be same or not. And the third practical way is basically, if you are working for a well-known broking firm, then you may get an opportunity to interact with the company's management in a conference call or in a one-on-one meeting when there is an analyst meet. So in that, at that time, we do ask them questions that what is your company's, how many projects that you have in the pipeline? How are you trying to get funds for that project? So they don't give an exact answer, but they give an answer that, we are trying to get the funds in the same manner that we have been doing. So that gives me a hint that they will maintain the debt equity ratio. Or else at times they give us the hint that we are planning to come up with an FPO, new fund offer, or we are planning to raise huge amount of debt from abroad. So all this gives us hint that how are they going to get capital? My view or my focus is always on, are they going to maintain the debt equity or they're going to change it? So it is an analyst's analysis. Based on that analysis, based on the information that they get, based on the things that they read from the past, and they see the trend, that's how they try to implement the weights. Got it? Clear? Yes, any question about weights? Okay. So this is how we understand weights and each cost of capital, correct? So quickly, guys, tell me, what are the approaches for debt?
Yield to maturity.
YTM approach, and the second is debt rating approach. Clear? Which one will you prefer to use?
YT.
YTM. But if you don't have price, then use for debt rating approach. Cost of preference shares, you only have the perpetual formula here, because in preference shares we are assuming they are perpetual, so you only get dividend over the price, right? If they are not perpetual, then you use the YTM approach for cost of preference shares also. The only difference, you're not going to deduct tax there in preference shares. Clear? For equity, 3 approaches quickly. CAPM, which is RF plus RM minus RF into beta. RF means risk-free. Generally, T-bills, treasury bills are said to be risk-free. RM is nothing but market return, which is nothing but index returns, which can be S&P 500 or Dow Jones returns. And then you have beta. Beta means sensitivity of stock due to market. Higher the sensitivity, higher will be the beta, and more riskier will be the stock, and therefore your cost of equity will be higher than market returns. After this approach, the another approach we did is based on Gordon's formula of dividend discount model, where you cost of equity is a combination of how much dividend you will receive and what is the price appreciation, that is growth. So D1 upon P0, dividend yield, and plus G. Growth happens when the company pays out dividend or when the company retains?
Retains.
when the company retains. So based on the amount it has retained and the ROE it generates, the return on equity that it generates on that money, that is where you get growth. So growth and dividend yield, that combination of both will give you cost of equity. And the third approach, which is only to be used, especially when you do not have data, that is bond yield plus risk premium. So you take the yield of the bond of that company and add an ad hoc or a subjective yield by the analyst. That is the approach. Of course, it's the least used, but that is also one of the approaches. Clear, everyone? Okay. Now we are going to discuss what happens when we evaluate projects, specifically when the projects of a companies which are not listed or of a business which is new. Until now, most of our discussion was based on companies which were listed, because in that cases you have all the data. But companies which are not listed, in such case, getting the data is very difficult. When the project is new, when you have not invested, this is a new project for you, the risk involved in this project is very much different from the risk of your other projects. In such a case, how do you find the cost of capital? That is called project cost of capital. Correct, everyone? Well, we are going to deal with that. What is the project's cost of capital? So let's understand what is project beta. By the way, what is beta?
Sensitivity.
Sensitivity of
Stock with the
Stock to the market.
market. Correct. Now, if I say project beta, it means the sensitivity of the project due to the market factors. Due to the market factors, which are also called as systematic factors. Due to the market factors, which are also called as systematic factors. It can be the macroeconomic factors like the change in interest rates, the change in tax rates, GDP, currency rates. Will these factors affect only my project or everyone's project?
everyone's project.
Market factors or systematic factors, they will affect only one project or every project?
Every project.
Every project.
Affect every project, right? So project beta here means a measure of systematic risk to the project. It measures the risk that projects have. Okay. So let's say if the market turns out to be negative 10%, then how much will be the effect on my project? That is called as project beta. Because a specific project is not represented by publicly traded security. Why are we doing this? Because our project is not listed. In such a case, it is difficult to estimate the cost. Clear? And therefore, it is difficult to estimate cost because you can't estimate the beta in such a case. So what we do, we use a method called pure play method. For example, let's say I have a business of education. I sell various courses and I do various financial trainings. Now I plan to get into another business. Let's say I plan to get into business solutions or IT solutions. I plan to start up that as a new business. Will the risk of this new business equivalent to, will it be equal to the existing business that I have? Of course not, right? So can I use the same discounting rate for the new business also? Will it be fair? It won't be fair. What if my company is listed, but currently my company's risk, even if it is listed, my company's beta is based on which industry? Education or the new industry that I'm getting into, IT? Right now it will be based on the education sector, isn't it, everyone? So will the new business also should it be evaluated at the same manner? No. So what will I have to do? I will have to see the risk of this new project that I'm getting into it. But then I can't use the same beta right now because the beta that I have right now is of which sector?
Education sector.
Education sector. So then I will have to see what are the identical IT companies which are having the same project as what I'm going to have. And I will use those companies' beta for evaluating my company's new project. Is that clear, everyone? This is called pure play method, everyone.
Yes.
So what are you going to identify? You are going to identify another company which is doing the same business as what you're planning to get into, same project that you're planning to get into. Everyone with me on this?
Yes.
And then you will take that company's beta and assume that the risk is same. But which beta am I talking about? Well, there are two types of beta. One is called the asset beta. Asset beta is the overall risk of the company. Asset beta is the overall systematic risk of the company. Systematic means market risk of the company. That is called asset beta. Now, first of all, asset beta is nothing but the weighted average beta of two things. Two things. What are the two things that assets are made of? Can you tell me from the balance sheet equation?
Equity and liability.
That is debt, correct?
Yes.
So beta of asset is nothing but the weighted average of beta of debt and weighted average beta of equity. Everyone with me? Beta of asset is nothing but weighted average beta of debt and equity. Is that clear?
Yes.
Everyone, please note this down. Please do write this in your books. Most of the time I have not told you to write, but when I do say write, please write this. Beta of asset is nothing but weighted average beta of debt and equity. The reason I've not kept this in notes is that because I want you all to write it, because only after writing you'll understand the formula. Otherwise you'll not understand the formula. Everyone written? What is beta asset? It is a weighted average beta of debt and equity. Clear? Everyone? Written yes or no?
Yes, sir.
Yes.
Okay. Now, beta of equity is nothing but what we understood here when we were discussing cost of equity. Here we understood beta of equity is nothing but the risk of the equity. So when the markets change, which means let's say when the S&P 500 will change or Dow Jones will change, how much will my stock get affected? Correct? That is beta of equity. But tell me one thing, when you invest in a bond for 5 years, if the Dow Jones changes, will your bonds price will also change?
No.
No.
No, your bond prices don't change because of Dow Jones. They change because of the interest rates. So if nothing given, beta of debt is assumed to be 0. Please do write. If nothing given, beta of debt is assumed to be 0 because debts don't change because of the change in the index. Is that clear? So if beta of debt is 0, what will happen to the formula? Have you noticed? What will happen to the beta of asset formula? No
It
one.
will be the beta.
It will be
Beta
equal
of
to
the equity.
This entire component will become 0. So it will only be weight of equity into beta of equity, isn't it? So now if I expand this beta of asset, what is weight of equity? It means how much is equity out of total debt and equity, correct? So we write this as equity over equity plus debt into beta of equity. Am I correct? When I do the weights of equity, equity over equity plus debt.
Yes.
yes.
Correct. Now, because debt has a tax component also involved, where is the tax adjustment that you did, in debt or equity?
Debt.
Debt.
Debt, right? So wherever you write debt, you should do it 1 minus t. That's a minor change in the formula. Why did I change the formula? Because debt is The debt does have a tax benefit. So debt should always be taken 1 minus t. Clear? Now, if I do some mathematics here, what will be the formula? See, this beta of asset will be, how can I reshuffle this? Any idea?
E upon E plus E upon like 1 plus.
Okay. Okay, let me take it on the other side. Okay, so now I will take beta of asset into E plus D 1 minus T over E will be beta of equity. Correct? I can use this equation.
Yes.
The reason I'm showing you this derivation is because this derivation is not present in the notes, but this will help you understand what exactly it is. So now if I were to recalculate here, beta of asset, I will do, sorry, beta of asset multiplied with, now I will put the equation E over E plus debt 1 minus T over E equals to beta of equity. Am I correct?
Yes.
Let's rearrange this. So I will get beta of asset into 1 plus debt equity ratio 1 minus T equals to beta of equity. Clear? And therefore I can say beta of asset equals to beta of equity divided by 1 plus debt equity ratio into 1 minus tax rate. Is that clear, everyone? So just check the formula here. Beta of asset equals to beta of equity over 1 plus debt equity ratio into 1 minus T. Make sense? So this is one formula that you have to understand, which is for beta of asset, and the another formula for beta of equity. So if you have either of the one, if you have beta of equity, you can find beta of asset. If you have beta of asset, you can find beta of equity. Clear? So when I want to find beta of equity directly, I can use this formula. When I want to find beta of asset, I can use this formula. Everyone with me? Everyone clear?
Yes.
So now you can see the derivation later on also. What is the formula here? Beta of asset is nothing but beta of equity over 1 plus debt equity ratio post tax. And beta of equity is nothing but beta of asset in multiply by 1 plus debt equity ratio post tax. Now, what's the difference between beta of asset and beta of equity? That is more important rather than the formula. Beta of asset is the total risk of the company. Total risk of the company should be same if they are in the same business. Remember, what should be same? Beta of asset of two companies should be
Same.
same if they are in the same business, if they are in the identical business. But overall risk should be same. Individual risk will depend on how much debt equity that company has compared to my debt equity. So if that company is using more debt and my company is using less debt, then my individual component cost may differ, but the overall cost should be same. So what is equity beta? Equity beta is nothing but the risk of the company in terms of the risk of the market to the equity component only, not the overall company, right? So every firm's equity beta will be based on what? The company's debt equity mix. So two companies can have same dash but not same dash. Can you tell me what? Two companies can have same which beta and not which beta.
Systematic.
The two companies should have which beta is same. Asset
Systematic.
beta or equity beta? Come on, everyone.
Asset.
Yes.
Equity bit.
No, not equity beta. How come two companies will have same equity beta? The two companies should have same asset beta, but its individual equity beta may differ because that depends on its debt equity ratio. So if you are using more equity, your equity beta will be different than a company which uses more debt, but the overall risk should be same. So I'll repeat, what is the conclusion? For two companies, what should be same? Two companies in the same business, what should be same?
Asset beta.
Their asset beta should be same, but their equity beta may be different. And that's what I need to find. Okay. So I will first explain you how this is being done. And then you can ask me all the questions that you have, that how is this practically done? So I've tried taking a very relevant example. First of all, why are we doing this? We are doing this because probably the business that we are getting into, that it is not listed, right? So even though our company is listed, but this new business that we are getting into, the new project that we are getting into, that is not listed. In that case, we may have to use this project beta concept. So now let me explain this entire concept with an example, and then you can ask me all the doubts. So Uber, what is Uber into, by the way, guys?
Transportation.
Correct. Transportation, you can say. But remember, recently Uber also went into Uber Eats.
Yes.
Correct. That is food distribution. Correct.
Yes.
So is the risk of that business similar to Uber's transportation business?
No.
No, right? So I've tried taking the same example. Uber is considering a project in food distribution. It has debt equity ratio of 2, tax rate of 40%, and debt currently has a yield of 14%. Coca-Cola, a publicly traded company which is already into food distribution, has a debt equity ratio of 1.5, tax rate of 30, an equity beta of 0.9. So guys, Coca-Cola has an equity beta. Uber's new business does not have an equity data, correct?
Yes.
Why? Because that is not listed. They've given the risk-free rate and the expected market return. Calculate Coca-Cola's asset beta. How would I calculate asset beta, guys? Coca-Cola's asset beta. It's company's equity beta I already have. How do I find asset beta? I need equity beta divided by 1 plus 1 minus tax rate into the debt equity ratio. So can you find this for me first, guys? And then we will discuss. What are the things that you will input here, everyone? Beta of equity. Yes. Your beta of equity for Coca-Cola is how much? 0.9. Correct. 1 plus the debt equity ratio of Coca-Cola is how much?
1.5.
1.5 into 1 minus tax rate. So 30% is the tax, so I will take 0.7. Let me know your answers once you are done with the calculation. Sorry? 0 point? Yeah. Everyone, please do the calculation. In your calculator, you can first solve the denominator. Store it. Then take the numerator, divide by recall 1. So your denominator
0.439.
your denominator is 2.05, your numerator is 0.9, divide by recall 1, that is denominator. You get 0.439. Am I correct?
Yes.
Now 0.439 is asset beta of Coca-Cola. Which business of Coca-Cola? Coca-Cola is into the food distribution. Now, the most important thing is that what is our assumption? Our assumption is that Uber's new business, the new business of food production, food distribution, that business asset beta should also be same as the industry asset beta of, or the Coca-Cola's asset beta. Correct? Because both are into the same business. So the asset beta of Coca-Cola and the asset beta of Uber's new business should be
Same.
same. So
Same.
now, if I use this asset beta as same, then I can find the equity beta for Uber's new business. Everyone, correct? So we use the same in the formula, but now what we will be doing is that we will take the debt equity ratio
The transportation business.
of Uber, not Coca-Cola, right? Overall Uber. What is the overall Uber's debt equity ratio, guys?
2.
It is 2 and the tax rate is 40%. So I will take 2 into 1 minus tax rate, that is 0.6. Clear, everyone? Let me know what is your answer. So you will do in your calculator, your 0.439, you should store 1. So 2 into 0.6 plus 1 into recall 1. I will get 0.9658 or 0.966, I can say. 0.966, I can write. Sorry. 0.966. Everyone with me on this?
Yes.
Let me know if you're getting the same figures.
Yes.
What is the main thing that I have done here? What is that I've assumed? Very important thing that I assumed.
Beta of the asset remains the same.
Beta of the asset of both the companies remain the same because they are getting into the same business. Clear? So here the project beta is nothing but the asset beta of Uber's new business, which is similar to the Coca-Cola business. That's a very important assumption. But in this calculation, the debt equity ratio and the tax rate I used is for Uber. Clear? So conclusion, both the companies dash is same, dash is not same. Can you tell me?
Beta of the asset is same.
Beta of the asset is same, but
equity ratio is not same.
Equities.
equity beta depends on their debt equity ratios. Clear? So now I've got equity beta for Uber's new business. This is how we find. And if I've got the equity beta and if I have RF and RM, I can find the cost of equity using CAPM. So as per CAPM, what is RF? RF here is 5% plus RM they've given is 12 minus 5. So I can write 12 minus 5 is, I can directly write 12 minus 5. You can directly write 7 multiplied with the equity beta of Uber's new business. How much is that?
0.966.
0.966. This is how I will get the cost of equity, which is around 11.76. Just verify that. This is the cost of equity for Uber's new business.
Yes.
Current cost of equity for Uber is not relevant. Why?
The business is different.
Because that business is different. Is that clear? Makes sense. Everyone understands the concept here? How do I get equity beta for the new business or the new project?
Yes, sir.
Well, now we've just got equity beta or we've just got cost of equity. Okay. We need to find the weighted average cost of capital for this business because Uber is not only going to apply equity, it is also going to apply debt. Correct? So how do we find the weights first? For weights, I need my weight of debt and then I need my weight of equity. Okay, guys, please tell me what is the weight of debt and weight of equity. They have they given any information about debt and equity for Uber?
Yes.
What is the debt equity ratio, everyone? 2. What do you mean by 2? What is the weight?
The debt is double than the equity.
So can you all tell me the weight? How do I calculate the weights? Weight of debt is? Come on, I've seen many people making mistakes here. What is the weight?
Debt upon the
6.
equity plus.
Correct. Debt upon equity plus
Debt.
debt. So the debt is, I can say 2. Equity is 1, you can say. Twice means.
Yes.
So I can write 2 over 2 plus 1, that is 3. So 2/3 is the weight of debt and 1/3 is the weight of equity, you can say. Clear?
Yes.
Remember, don't make a mistake here. 2:1. 2 debt, 1 equity. So 2 divided by 2 plus 1. Correct? Now you've got the weights. So how do you find the weighted average cost of capital? So you are going to find the weighted average cost of capital, for which your weight of debt into cost of debt. What is my cost of debt, guys? Here I will take always 1 minus t. Remember that. Okay, don't forget that. Cost of debt. Have they given me any cost of debt here? Yes, they've given me that the yield of the company is 14% and the tax rate is 40. So I will do 14 times 1 minus 0.4. Don't forget to do that. So your cost of debt will be 8.4. And your cost of equity, which we have already calculated, is 11.76%. Based on this, if you find weighted average cost of capital, so just multiply the weights and the cost. So your weighted average cost of capital, I will write here, this is cost. Your weighted average cost of capital is weight 2/3. So 2 by 3 multiply by 8.4. Store 1 plus you will do 1 over 3 multiply by 11.76. Am I using correct weights? Just verify that. I'm getting 9.52. Let me know if that is correct. You do store 1 and store 2 and then find it.
9.52.
9.52. This is the overall cost of capital for Uber's new business. In that, finding debt was easier, but finding the cost of equity, what did we do? Because this business was not listed, we use an identical company's asset beta. And from that asset beta, we employed our debt equity ratio. We employed the Uber's debt equity ratio. And then we found the equity beta for Uber. So what is the only change that you did from that company to your company? What was the biggest change in both the companies?
Debt equity ratio.
Debt equity ratio. This debt equity mix of both the companies is called the leverage. Which company had more or less leverage? So first you calculated asset beta of Coca-Cola. Then you readjusted the debt and put the debt equity ratio of your company, that is Uber's new business. This is called lever unlever. This is called lever unlever. Lever unlever means you had taken the other company's debt equity and now you unlever and take the new company's debt equity. That is called lever unlever. Are you getting it? Correct. So it is written here, beta of asset. What did we do with beta of asset? And then how did we find beta of equity? Now all this will make sense. First of all, everyone got the answer 9.52?
Yes.
Anyone stuck with calculation? Now what we exactly did here is what I want you all to read now, the concept which will make more sense. So anyone can read for me what is beta of asset here, please? I will just zoom it out. Yes, anyone would like to read what is beta of asset and we'll connect it with what we did. Anyone? Go for it.
The beta of a firm is a function not only of the business risk of its project, but also of its financial structure.
Yes, so beta of asset considers two things: the overall risk of the project and the debt equity ratio. Correct?
Yes.
But what is same and what is not same between two companies. The overall risk can be same between two companies, but the debt equity ratio of two companies will be very different, right?
Yes.
So we need to adjust for that. That's what the second point is. Read that.
Therefore, we need to adjust the pure play beta of comparable company for the leverage it uses by unleveraging it, and therefore by readjusting it based on the financial structure of the company.
Correct. So when I'm taking asset beta of another company, the overall systematic risk can be same, but my company's debt equity ratio is very different from that company. Then I may have to lever and lever, or I will have to readjust the debt equity ratio. Now just assume if both the companies have same debt equity ratio, then you can use directly that company's equity beta also. Are you getting my point? I'll repeat. If both the companies have same debt equity ratio, then
we can use the same equity beta.
You can use the same equity beta. But if both the companies have different debt equity ratio, then you use the beta of asset and readjust that by taking your own debt equity ratio. Is that clear?
Yes.
So two companies in the similar business should have which beta same? Asset beta.
Asset beta.
But its equity beta depends on the debt equity its component beta depends on the debt equity ratio. Clear, everyone? And therefore we find the beta of equity, and this equity beta helps us determine what? It helps us determine the cost of equity. And based on this equity beta, we used it in CAPM, which we did here in CAPM. We find the cost of equity. Why did we do all this big stuff? Because the project was not listed. Our project was not, had it been listed, we would have directly got the beta. Then we would not have to use another company's beta in order to find this. Clear? So if not listed, if the project details are not available, if it's a new business, then you will have to use the concept of project beta. This is called pure play method. Pure play means you use another company's reference data to find your company's valuation, to find your company's beta. You plug it and then you get the cost of equity. If you already have the cost of debt, and if you have the weights, which definitely you have because of the debt equity ratio, you can find the weighted average cost of capital of this new project. Is that clear? Everyone?
Yes.
But here are some important notes while you do all this thing. There are some issues involved in estimating the beta. It doesn't look as easier as what it is, visible here with mathematics. First of all, when I'm comparing Uber's new business with the Coca-Cola's food distribution business, even if the business is same, is the scale same?
No.
Of course not, because Uber is entering into that business and Coca-Cola is already there into that business from the last decades, so many decades, correct? So who is more riskier relatively, Uber or Coca-Cola?
Uber.
So I cannot simply say it's exactly same, because I'm not comparing the same level of companies here. So there are various challenges involved in using this pure play method also. Okay. So first of all, beta is estimated using historical returns data. And we all know historical data is subject to, many biases, and there are various issues there. Historical data has time issues also. Are you taking 1 year data or 10 years data? The data can change drastically based on the duration that you take, correct? So they are very much subject to bias. The estimate is affected by which index you choose. For example, here RM, return on market, which market? For example, in US also you have Dow Jones and S&P 500, both are different markets. Which market? Both will not exactly have the same beta. There will be minor difference. Betas are believed to revert to 1 over time. So at times the beta can be greater than 1, at times the beta can be less than the 1. On the long run, they are estimated to be around 1. So when you adjust them, this adjustment needs to be with the mindset that they will eventually revert to 1. So all those are challenges. The conclusion is that the beta is not constant. It continuously changes. So your cost of capital will also not remain constant. You can't say that this is the cost of capital forever. No, you'll have to readjust them, correct? And see, if your cost of capital keeps on changing, your project's decisions will keep on changing. So what is feasible now may not be feasible when the cost of capital increases. Correct. That's what the issue is. And what I told you, that estimates for small cap may need to be readjusted upwards. For example, your Uber's risk will be slightly higher than Coca-Cola or less than Coca-Cola, even if the business is same.
Higher.
Higher. Therefore, I will have to readjust. You remember we discussed here that we will have to readjust WACC if the risk is relatively higher. Remember this discussion? So here also, if the risk is relatively higher, then you cannot use the same equity beta. You'll have to slightly increase the equity beta. You cannot keep it the same. And that increasing depends on the analyst's perception of how riskier it is. But there are challenges. So first of all, the industry, yes, the industry uses this concept. So tomorrow when you will be evaluating a private company or a project which is not listed, in real life also, when you join a bank or an investment bank or any valuation company, you will be using this concept only for sure. But you should also be aware of the challenges and accordingly see, even though all the analysts here in the class may use the same technique, but then it depends on your perception of your adjustments, what adjustments you do, that will define you as different from others. And that is being left to the analyst's experience and his judgment. Okay, got it? Everyone clear with project beta concept? Any doubts, anyone?
Yes, sir.